You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
Hey everybody, Quasar Markets Live. Welcome. I have my friend Gordon Scott, former head of the CMT Association. I'm super excited about this, Gordon. How are you doing, man?
I'm doing all right. Thanks for having me on here.
I think that one of the cool things I like about Quasar Markets Live and what we're doing here is that we do have the veteran traders on here, the people that actually know it. And when I see that big CMT, those three letters beside someone's name, that makes me very happy, because I know that you actually have the pedigree behind it, that you're not just talking about charts. You're actually people that are behind the whole system itself. And I want to talk to them a little bit about yourself. So Gordon, tell everybody here about you, how you got started in the world of investing and trading, especially technical analysis, and then we'll get right into what you're doing.
All right. Well, I was an employee for IBM back in another life. I worked for IBM for 10 years, and then I got the wonderful brainstorm to leave IBM and be part of a startup company, the customers of which were all software and internet based small startup companies themselves. We provided consulting services and outsourcing activity. And the year was 2000. So you know where this story ends. Dot bomb 2001. And I'm unemployed in a significant way for the first time ever in my life. I remember the week before 9/11 going to a job fair, and there were 1,500 guys literally in suits waiting in long lines for 10 different jobs, just 10 available jobs. And the only one of the 10 I was potentially qualified for was a line that was literally a 45-minute wait to just throw your resume on the stack in front of some very bored, very tired booth attendants that were watching an ever-growing, messy stack of resumes. After about 20 minutes, I realized this is not a productive use of my time. So I threw my stack on the resume and walked out and wondered, what am I going to do now? This seems really serious. So I went to the library, and this was September 11th, 2001, and the TV screens in the lobby of the library, I mean, you know what they were playing, right? And I just looked up there, and I was a little wrapped up in myself in that day, and I just thought, oh, there's what my career looks like right now. And I went inside, sat down at the desk, and thought, what am I going to do? I got a family of 5, I got the biggest house I've ever owned, biggest mortgage I've ever had. What am I going to do? And although I had had a little bit of experience trading my 401k, literally just using IBM stock, getting in and out with my 401k, and I had done well. I had actually doubled it independent of my contributions, but I didn't really know what I was doing. I sat down there and I just thought to myself, if I were to do my career over starting right now, what would I pick? What would I choose to do? And the thought came to me, stock market. And I had no training in, I didn't get a financial degree from school. I got instructional design. And so I really had not a good reason for thinking for that coming to my mind, but it was true. That was what I was passionate about wanting to learn. And so I thought, okay, I'm going to do that. And I was in the library, so I checked out every single book I could find, Harry Dent, Wade Cook, Benjamin Graham, anything. And in reading all this stuff, I came to the conclusion there is a way here. There's got to be a way to make a go of this. So I'm going to try it. And for the next 2 years, I taught myself about trading and went through a bunch of experiences. And that formed the foundation of really the second half of my career and where I've been ever since, both learning but also teaching others about trading. I managed to get a job at Investtools. This was back in 2004.
Mhm.
And by 2006, I was the head of content. I was the content director. So I was in charge of all of the lessons and books and stories and whatever we were, packaging and selling. And it was my job to make them legit, not just, um, uh, hotel conference room hype
Right.
experiences, but to actually make sure that, there was numbers, there was stats, there was, real stuff behind what we were providing. And it just so happened in that same year, Investtools merged with Thinkorswim. So I got to
Mhm.
meet Tom Sosnov and Steve Quirk and JJ Kinahan and all those guys, and sort of help with the bringing together, because their style was literally polar opposite of ours. We were talking about buying options, they were talking about selling options, and
Right.
so we had to find a way to reconcile both of those. That job fell to me. I revamped the Invest Tools curriculum, and a year and a half later, when TD Ameritrade came along and wanted to buy the whole thing, they looked at it and said, "Oh, this is pretty good. We just need it to be FINRA compliant." So I spent another year being just making the detail FINRA compliant. But I was a trader at heart. That's what I had decided in the library, was I want to do trading. And
Right.
in that whole year where I was doing FINRA compliance work, I thought, this is not what I that's not why I joined Investtools / TD Ameritrade, right? So I actually left of my own volition. That is, I decided I want to try doing something more entrepreneurial, and so I started working with people who were coaching and who needed consulting. I got to work with Van Tharp and
Mm.
Price Headley and Steve Nissen. I did a lot of work with Steve Nissen. It was pretty fun, because I got to go around and talk to all sorts of people who had a wide variety of ways to trade. And then in 2013, I had the opportunity to become the managing director of the CMT program.
Yeah.
And so when I did that, I met even more people with different ways of trading or investing. I sat and listened to a presentation of Tom um, uh, DeMark, a lot of Toms, Tom DeMark, and he gave his story of how he had been, Merrill Lynch basically spent 15 million on him trying to educate himself in technical analysis. And so my vision on technical analysis expanded even further. I'd become a CMT while I was the content director at Investtools, but now that I was in charge of the program and in charge of the curriculum, I noticed that I had to do one important thing with it. The focus up until that moment was on pattern recognition and a lot of stuff that you typically associate with technical analysis. And so while I didn't want to discount any of that, that's kind of the backbone of the whole discipline. The reality is, when I talked to people about how they used it in investing and trading, I saw something else emerge that wasn't in our curriculum. And that was this deep emphasis on risk management. And I
Mhm.
realized, if I were to try to focus on predictive power of trading, of technical analysis signals, I'd have a real uphill battle. That's where the whole world of fundamental versus technical, like, oh, you guys, you and your technical signals and your little head and shoulder shampoo, whatever. Forget that nonsense. That's where it comes from. Is the idea
Right.
that if you try to put your energy into using a technical analysis signal for prediction, and you say that's where my value is as a trader or investor, then that's a hard argument to win.
Right.
But if you say, I'm using technical analysis for risk management, I understand the setup, I understand how much I'll risk, I understand how much I can gain, I balance the risk and opportunity management in such a way that I have an edge over randomness and an edge over the markets, right? If I use technical analysis for that purpose, that's an easy argument to win. And that's what I really learned when I was at the CMT. And when I left the CMT in 2018, I started working with a variety of people, Investopedia, and again, more with Van Tharp. But all along the way, I was looking for a way to really encode this knowledge that I had into something that could give people a better use of technical analysis. And just 2 years ago, a nearby neighbor and friend of mine, who's this crack programmer, but doesn't know very much about the markets, or didn't before he started working with me. He came to me and said, "Hey, I've got this tool I want to show you, and tell me whether or not you think it's interesting." And of course, I was blown away. I was just like, "Yes, I'm interested. Let me just do whatever I need to help you bring this to market and make it a reality." And since then, he realized that my knowledge in learning and technical analysis and trading and investing was deep enough that he needed to incorporate that into the product. So he made me a co-founder, and the two of us developed what is now myedgefinder.com. And it is a really cool tool because it creates a new kind of analysis through machine learning. And the data that I want to share to answer this question comes from that tool.
Yeah, and I think it's really cool. A lot of people don't know when they first want to get into the markets. I'm in this position, I'm in this job, I'm in this sector, I'm not in the financial markets. And you're a breath of fresh air for those of us who started out in the financial markets and learned at a young age from me. But that when you can be at IBM, you can be at other companies and give up. We just had Kevin Koharki, same thing. Hey, I wasn't in the markets. Now I'm a professor of accounting, right? So that's a breath of fresh air to a lot of people that need to understand that. And what's cool about it is now for the first time in a long time, I've been saying this, that fintech is actually catching up, and we're at that place now, right? That we're now seeing the markets and the finance world and technology come together. And your new company, myedgefinder.com, by the way, if you don't know, click on that button right now. Excuse me. Make sure you go to their website and check on it. And check him out too. I'll give you his ex account there as Gordon SCOTT CMT. But I'm going to turn it over to you because you have a pretty exciting thing today, and it's called "Are Breakouts Better Than Reversals?" He's going to show you today how it actually works. I'm going to turn it on to you, and I'll see you in a little bit.
All right. Well, if you're in boss mode and looking over your shoulder, let me give you the TLDR: breakouts win. So how do I come to the conclusion that breakouts are better than reversals? Well, the longer form of the story is, breakouts are better most of the time and for the right assets. But there are times where reversals are better. I hope to be able to give you a sense of when that is and how I came to this conclusion. So as I mentioned earlier, I've been working on this product, myedgefinder.com, and let me give you a quick rundown of what it does. This is a tool that has the ability to take, both backward testing and forward testing. So what we did is we used this tool to generate data. We generated over 260 trading solutions for SPY and over 100 for the Euro USD forex pair and for the dollar yen. We plotted out of sample performance data for the past 3 years, and we compared the 20 years previous. So we did back testing, 20 years of in sample data, and then forward testing, 3 years of out of sample data. And this is what we're collecting. Now, we're looking for the performance of these systems and the edge. And it's important to understand the edge is defined as a winning percentage greater than randomized prices would predict. So in other words, if I buy something and I put a stop loss, let's say $1 lower, it's a stock, right? $50 stock, $1 lower, and a profit target $1 higher. So I have that equally distant stop and target from my entry. And this holds true for anything, forex, stocks, futures, anything. If you have an equally distant stop and target from your entry, you have a 50-50 probability of winning or losing the trade. And this isn't just me making that up. That's established. In fact, options and futures pricing uh, 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 market makers who have models, mathematical models for pricing, they build their models starting with that assumption that randomized price movements have 50-50 probability of going either way. Well, if that's true, then all you have to do is change your stop loss and target numbers to change your anticipated win rate. So if you risk $2 to make $1, that you're going to win 67% of the time. You're not going to make any money. You're just going to break even, but you are going to win 67% of the time. So I can't simply say, well, if I have a 67% win rate, that's a better system. Well, what's your risk reward profile? You got to take all of those factors into account. Well, we used my Edge Finder to do exactly that. And that's how we did the data, or how we generated the data. See, Edge Finders, just to give you a quick look at the screen here, it's a tool that evolves solutions out of the possible landscape of trillions upon trillions upon trillions of possible combinations of technical analysis rules. We have over 200 micro categories of the rules, and then 10 to the 500 possible combinations of them. But we have four main categories of strategies: breakouts, continuations, crossovers, and reversals. So for this data, I wanted to generate a bunch of breakout systems and a bunch of reversal systems and compare what they, how they came out. So I would just come in here, I put in SPY, and I would select, breakouts and specify risk 1 to make 1, meaning a 50-50 probability, and try to give me a system, give me a set of rules that would outperform randomness, better than 50% win rate, and better than 50% or equal win size, that sort of thing. So with that in mind, then I went and looked for the out of sample stats. So I found all the best rule sets that did that through what's called genetic algorithms. It's a machine learning technique. You can Google it. It's there. Look for the 6-minute video on Google, or on YouTube rather, that talks about genetic algorithms. That's the stuff that's going on behind here. But we use genetic algorithms to evolve a solution. We take all of our available data and treat it like it's a DNA string, and then we make these DNA strings of different possible solutions compete against each other, and we look for ones that are better than at least 5,000 others, and we start with those. So each plot on the data, or each data point on that chart that I showed, and I'll come back to it, is a solution that is demonstrably better than 5,000 other solutions that we tried. And all of these solutions in backtest outperformed the market, but we also wanted to see how they did out of sample in the 3 years after the backtest data. And so that's what we're looking at, the comparison between the overall performance and the overall edge, right? And so you can see here, this one, for example, this would have as an average reward to risk ratio of 0.83. So it's a little bit less than 1 for 1. Comes out at, about, risk 10 to make 8.5, something like that. And the win rate is 81%. So that tells you that the average win is a little smaller than the average loss. But versus buy and hold, this comes out 57% better. And this is an out of sample result. This is after we did the 20 years. The next 3 years, we beat buy and hold on the SPY by 57%. And the edge on this was 25%. So in other words, we would expect to win something like between 55 and 60% of the time, but we ended up winning 81% of the time. So this is a very good solution. It's an example of where we got to by doing all of that evolution of systems. And the fun thing is, it only takes about 10 to 20 minutes for the system to generate this kind of solution. And this is just a sort of heat map style look at the results. Green's a win, red's a loss, darker colors are higher magnitude. Whites are unfilled trades, like a limit order, and the price didn't come down and hit the limit order. So you can see that the 20 years, that's the big box here, 20 years of data looks like this, and the more recent 3 years of data looks pretty similar. So whatever edge was discovered from this particular solution, this set of rules that were evolved, was pretty good because it worked for 20 years, and then for 3 years later, it kept working. And that's what we were looking for. So the method for generating our data was to let My Edge Finder discover solutions with 50-50 expectations. And then we evolved them until we got better than 5,000, and we got, just 260 different solutions for reversals compared to breakouts. And then we compared where did all the data fall for the different systems. That's where we come to this. So what I'm showing you here is just, this is everything, but you see the breakouts, the reversals are down here. They're these colors, they're all concentrated down here. One means that you're equivalent to buy and hold. Anything further to the right is better than buy and hold. And this is for the reversal systems on SPY. And this is the idea that you're going to try to buy the dip and fade the rally and take small profits. That sort of strategy. Over here is the out of sample win rate edge. You can see that most of these systems have between 0 and 5% edge. So the number isn't very high. The breakouts, on the other hand, they can get edges up to 20 or 25%. So they stretch way into there, and their performance exceeds the reversal solutions because the data comes way out here to 1.2, 1.6, and so forth. So you can see pretty clearly breakouts performed better than reversals when you're looking at the data of solutions traded on the S&P 500, specifically, of course, SPY ETF.
Yeah. And what's interesting on a day like today when we had NVIDIA breaking all-time highs and being the first $4 trillion company, is that one of those stocks that you'd be looking at too, the same situation with this whole breakouts better than reversals?
Yeah, interestingly enough, I run a trading advisory called Beyond the Edge, and I actually sent out an advisory trade on NVIDIA this morning for that very reason. It's not only a breakout, it's a gap, and it is leading the Nasdaq 100, and there's an edge on such signals. We'll see if it closes, but there was a CMT in the Journal of Technical Analysis back in 2013. There was an article published that talked about gap signals, and NVIDIA's action today, assuming it closes in the top 80% of the trading range today, is a textbook example of that study. And that study showed that there definitely was a better than buy and hold of benchmark kind of performance that you could get from starting off with those types of signals and then holding for at least a month. And so the interesting thing is they wouldn't even, that solution wouldn't even get in until the day after the gap. So they would be entering like tomorrow at the open on NVIDIA. I figured, it is not coming back. There's really, we got Fed minutes later today, but after that, there's no serious news throughout the week. So I don't see NVIDIA giving it back today. And so, yeah.
And I like this with My Edge Finder that when a person's using it, they don't have to worry about, did I miss the boat on this trade? It's not like they have to be stuck to their machine all day, right? Is that correct?
Oh, yeah. No. These are actually end of day signals. So they appear about 3 hours after the market closes, and then you
Mm.
have all the way until the next day in order to get the signal in. It gives out, here's the entry price, tells you whether it's a limit or a stop. Here's an interesting little thing we found in our research, that when you do breakouts, you're better off using a buy stop or a sell stop, but entering with a stop, not with a limit. So in other words, when you buy a breakout signal, you want it to actually break out. You anticipate, here's where the breakout should be. I'm going to buy it if and only if it does go high enough to break my target or my resistance or support level, or whatever it is I'm seeing. If you do that, you increase your edge by 2 to 3 points just for using that kind of an order. Fascinating and counterintuitive, because most people want to buy low and sell high, right? We're
Yeah.
literally talking about buying high, selling higher with breakouts. And so that was an interesting part of our research that we discovered.
Awesome. I love this, Gordon. And, I think one of the cool things is you're part of us now, Quasar, coming on and be an educator as well with My Edge Finder. I love this a lot. We're also partnered with CMT Association, my dear friend Tyler Wood. I'm looking forward to more with you, Gordon. If you come back on the show a whole lot more, we'll have you on here and we'll get you out there. But look, folks, it's real simple. Click on that button. Click on myedgefinder.com. You know how to go on the website. If you don't, you're already here on the internet. So there we go. And if you want to, do me a favor, give him, Gordon Scott, give him a big follow there on x.com, because he's giving those things out for free. And that's not normal for someone who's a former IBMer himself, who's now former head managing director of CMT Association and now co-founder of myedgefinder.com. Gordon, thank you so much for being on the show today. Look, I'm looking forward to seeing you in a week or two, and we'll do this again, man.
All right. Thanks so much, Steve.